Hello again, and Happy New Year. It's Mark Masterson, Managing Director and Partner here at Hightower Naples, and I'm bringing you the kickoff market and economic commentary for 2026. I titled this one Seasons, and hopefully you'll see why as we move through the pages. So let's jump right in. For everything there is a season, and a time for every matter under heaven. Of course, from Ecclesiastes. I think what you're going to see as we move through is that we may be entering a new season on a number of fronts, economically and in the markets. But we start with the four horsemen. So the four horsemen are mixed. Fundamentally, starting the year bullish. I'm going to show you why. Q1 is front-end loaded with a lot of stimulus, so we'll talk about that. Technical is neutral, not for any other reason besides a number of fronts were overbought and things are a bit stretched, but technically no damage anywhere. Sentiment is bearish, contrarian indicator. So as we begin 2026, everyone's bullish. So naturally, we've got to lean a little bearish on the sentiment front. And then finally, policy. If I could make this uber bullish, I would, because it's all throttles, all systems go on the policy front. The Fed's cutting rates. They've started QE. Global central banks are in easing mode. Fiscal spending remains in massive deficit levels. So all systems go on a number of fronts as we enter Q1 on the four horsemen. So let's jump into those fundamentals. Tis the season for positive economic data. That's what I'm seeing as we start the year. It's going to be a good Q1. You can see the economic data has been trending upwards anyway the last few quarters. But as we start the year, we've got a lot of tailwinds. So you have obviously the big beautiful bill. Talk about that. Rate cuts now at the Fed. QE started December 12th, a reform of QE from the Fed. The deficit spending is pretty extreme. And then we've got other tailwinds potentially like tariff dividend checks and things that have been talked about. But one of the big ones in Q1 is this big beautiful bill where you've got a lot of tax refunds that are going to be kicking in. You got standard deductions risen, inflation adjustment, increased child credit, SALT caps are up, senior deductions, no tax on tips and overtime, auto loan interest deductibility. And then one of the big ones often overlooked is the full and immediate expensing of U.S. manufacturing. And that goes back to 2025, so January 1. So you're going to have a lot of refunds coming through, all very, very stimulative. At the same time, the administration is still running big deficits. I mean, you can see that the deficits obviously been rising year over year, going all the way back the last 4 to 5 years. We have averaged 1.8 trillion. But when you look at the fiscal year that we just kicked off, we're a couple of months into it, and we ran about 740 billion of deficits, or the government took in 740 billion, 456 billion in deficits, which is annualizing, which is unfair to do only 2 months into this. Hopefully this is going to come down, but right now we're annualizing at about 2.7 trillion in deficits. So pretty obscene, frankly. And of course, that's being seen in the expansion of debt. Our national debt is now up to almost $39 trillion. And a lot of that just happened in the last 6 months. We added $2.3 trillion of debt from July 3rd, which is when they raised the debt ceiling, to the end of the year. So expect that to continue. And again, that's all deficit spending, borrowing and spending, and contributing to economic growth, but certainly has longer term implications, as we know. At the same time, we know that interest rates have been coming down. The Fed's been cutting rates. These are just some old posts from Trump, hammering away at Powell and demanding rates come down. And this one's pretty new. I just added this because it tells us a lot about next year. As we know, it's going to be tis the season for rate cuts because, Trump posted at the end of the year last year, the Trump rule, and it ends with anyone who disagrees with me will never be Fed chairman. Well, we know that's for sure. So you can expect come April, May, when Powell is out, whoever's in is going to be cutting rates. What I find really interesting is the 2-year Treasury yield usually leads the Fed funds rate. And as you can see, they're pretty much in line now. So the market's telling you and telling me and telling them that rates really don't need to go much lower. That doesn't mean they won't, But you can see the 2-year Treasury yield led the Fed here. It started rising, then the Fed started hiking. It started falling, then the Fed started cutting. But they're pretty much aligned. Got to keep an eye on that. And then, so Q1, we have tis the season for positive economic growth, but I don't want to ignore some of the post Q1 narratives that may come back uh, to show a little weakness. Let's take a look. First of all, leading economic indicators, things that move ahead of the economy, like orders, hours worked, sentiment, credit conditions. You can see they're moving lower while the broad economic data is rising. What does that mean? Not much in the short term, but you can see in the past when that red line is tilted down, you've had these gray bars, which are recession. So maybe that leading economic indicator is telling us something. Job growth is stalled. You can see barely added any jobs the last 3 months. Um, we've seen a lot of layoffs. 2025, we had 1.2 million job cuts. So, the job market has been kind of weak. And with layoffs, you tend to see unemployment leaking higher, which it is. And in the past, you can look and see when unemployment started to rise, usually it was ahead of a gray bar. You can see it every single time. So we're not seeing it yet, and I doubt we'll see it in Q1. But as you look past Q1, it's not something that I think we should completely rule out or ignore. The other side is spending. 70% of GDP is consumer spending. And I can tell you, these University of Michigan surveys are just showing the consumers are in the dumps. They are just not feeling great. And that's kind of a strange thing when you think about it, with the economy and the markets doing fine, but the consumer is feeling gloomy. Not all consumers, because I can tell you the top 10% of wage earners are now over 50% of that spending, which is certainly holding up the economy, no doubt about it. But we need to keep an eye on that. And I think one of the reasons why consumers are feeling so gloomy is the compounded impact of inflation. Yes, inflation is only 2 to 3% now. That's fine. We can handle that. But when you look at the United States inflation being the second highest over the last 5 years at 24%. So you have a 24% increase in spending over 5 years. It's that cumulative impact on things that's hurting the consumer. And you can see it in the polls. 46% say the cost of living in the US is the worst they can remember it being. Including Trump voters are feeling that way. So this, I think, is one of the challenges that the administration is going to face in the midterm election year. And you look at the 2% inflation rate, it's a little bit of a myth, because as of the end of the year, you look at the cumulative price increase over the last 5 years of things that matter. How about eggs, auto insurance up 66%, beef, fuel 54%, gasoline 50%, home prices 45%. These things are hard to swallow for most consumers. So I think that's an issue as we move into maybe past Q1, for see how that tends to come down potentially, and how spending responds to that. Because what we don't want to see is a repeat of the 70s. You can see, this is chart's a couple of months old, but you can see that in the 70s we had waves of inflation. So you had the blue line where you had a wave up and then down, and then a third wave higher. And you can see the inflation CPI this time around kind of looks similar, and we're now kind of in this range. And if it starts to come back up, that's going to be a big problem. So it's something to watch as we move into not Q1, but as we move past Q1 into Q2. Let's take a look at capital markets. We'll do a quick recap and talk about seasons as we move into this. So the S&P had a great year, 17.9, 18% last year. Very strong year, as we all know, but it didn't start that way, right? I mean, the beginning of the year was down. This is a great chart because it shows that even in strong years, you have drawdown. So we were down 19%, in the beginning of the year, and then we staged one of the largest comebacks ever for markets to finish the year strongly. And you can see volatility is always, there's a lesson in this, that volatility is always part of the equation, but last year was pretty extreme in terms of the swings. And there was a lot of reasons for that. We can talk about that offline in terms of how the changes that were made to policy to continue to stimulate. But this chart is what I think is most notable. And I call it, again, are the seasons changing? Because I just talked about how great the S&P was. had a great year at 17%, but look at how everything else did better. You had the NASDAQ, of course, tech and the Mag 7 did fine. But what about global stocks outperforming the US? We don't see that. We certainly haven't seen that. So perhaps there's a season change there where we're going to finally start to see maybe a little bit of rebalancing in some of the international markets outperforming. Emerging markets are up 34%. Gold, of course, had a great year. How about uranium? How about rare earth, silver? Commodities in general had a great year. So we may be starting to see a new season emerging where US stocks that have been so dominant over the last 15 years start to take a bit of a backseat to other places. That's certainly on my radar and part of my main thesis. You can see in the commodity space, it was not uniform. So I just highlighted the precious metals, gold, silver. How about industrial metals like copper doing extremely well? Real assets had a good year. That's a new season. That's different. But it wasn't everything. How about the energy complex all down? Where would inflation have been if energy had not been down? So, perhaps 2026 may be the season for energy, a new season upon us where we start to see a resurgence there. But be careful what you wish for, because if we see that, then you're likely to see a resurgence of inflation as well. And lastly, bonds. Bonds actually came to the table with a decent return last year. It's been a while, but I highlight here the new season for bonds and interest rates because as you can look back over the last 3 or 4 decades, bonds had a great return for decades. This decade, 5 years into it, the average annual return is only 1%. So I think we may be in a new season upon us where inflation stays stubbornly high, interest rates stay higher, and again, bonds only appreciate when interest rates are falling. So if you're in a regime where the season is interest rates start to leak higher, bonds are going to struggle a bit. Good for cash flow, but total return may be more difficult. So that was the quick recap of 2025. Let's take a look at some of the extremes that we saw when we finished the year. And again, 'tis the season for extreme concentration. I'm highlighting here some risks, perhaps, as we move into 2026. Things that are on our radar that we're looking at when you look at possible season changes. Certainly, the S&P 500 having the top 10 positions at 40% is pretty extreme. It's a historical high, but you can see this has been marching higher for years now. And that's what happens in a bull market. Everybody tends to go into the same names. They get bigger and bigger and bigger, especially in a world where passive management is feeding that beast, index funds, etc. But it's not just the top 10 stocks. It's the top 10% of the S&P is 78% of the market cap. So 10% of the market is now 80% of the index. That's pretty extreme. And it's led by technology, as you might imagine. You've got technology here, which is now 35% of the index. Defensives are only 19%. Why is that notable? Well, if you go back to 2000 during the tech bubble, technology got all the way up to 34.8. So we hit a new high there. And defensives got to 21.6. Defensive sectors being consumer staples, energy, healthcare, utilities, things that are a little more low growth, if you will. Well, in both of these cases, we just hit a new extreme, a new high for tech and a new low for defensive. So how about this for a possible season of change? Certainly when you got to this extreme, the catalyst of the tech bubble bursting brought that down, and you saw a multi-year run where the defensives outperformed. It was a season of change. And at some point, we're going to see this reverse and head higher and tech roll over. So you're going to have a new season perhaps coming up in the next year or two, maybe even the next quarter or two. Time will tell. How about another look at a similar structure as you look at the equal weight S&P versus the market cap? I highlighted to you earlier that it's the most concentrated market in history, which means that if you look at the S&P 500 based on market cap, as those top 10 companies are performing better, the index is doing better. It's kind of an indexer's dream, which means that if you equal weight, you take the same percentage weighting of all the names in the S&P 500, it's going to underperform, right? Because as long as the top 10 names are the Mag 7, et cetera, are performing well, you get outperformance. Well, how about this for a new season? The last 3 years, we saw the widest 3-year performance gap between the market cap and the equal weight in history. The last time we saw that was 97, 98, 99. right before the tech bubble burst. And when you saw that, you saw 6 years after that where the market cap underperformed the equal weight. Perhaps we're entering a period of time where that season shall change. It's been a tough run for equal weight. You can see it visually here. Here's the underperformance going into the peak of the tech bubble, then the outperformance of equal weight, meaning the market cap underperformed. We've got 3 years here. At some point, we're going to have some outperformance on the other side. Seasons changing. Same thing here about how narrow this market is. 35% of stocks are beating the index. That's what happens in a heavily concentrated market. You can see the last time that it was this narrow was back here at the end of the 90s bull run. Pretty extreme. And lastly, managers are struggling. You can see that only of active managers, only about 30% outperform the index. That's what happens in a concentrated market, because if you don't hold those 10 stocks, you're clearly going to underperform the index, which is fine. It's an indexer's dream for a period of time. But then you get a year like this where 61%, where the index is down and active managers drastically outperform. So if you're going to index, this may be a period of time where you consider equal weight as part of your portfolio structure. Well, not the last, we'll look at sentiment too. But from a seasonal perspective, what season are we in when the market overvaluation is this extreme? No matter what metric you look at, we're pinned to the extreme highs in terms of market valuations. You can look at price to earnings, right? Forward PE. This is probably the most common, which is why I put it here. We're at about 23. We reached that here. And then the last time we were anywhere near this level was back in the tech bubble, where we got almost to 25. So you can certainly go higher. And I will tell you that valuations are a terrible market timing tool. There's usually a catalyst that tends to flip the switch for the market when you get overvalued. But I will tell you that market valuation does tell you that you're priced for perfection. So you better keep getting some good news, right? So the PE level, again, at 22, 23 is pretty high. If you look at that historically, it doesn't mean anything in the short term. Markets can keep, you can get a higher PE for sure. But in the big picture, looking at the data, anytime the PE has been 22 or above, which is this green line, the 10-year returns for the market have all been negative, flat to negative. So the big picture is long term, buying the market when the valuations are this high is not a great recipe for great returns. Obviously, you want to buy them when the valuations are lower. The long-term returns are better. Buy low, sell high. We tend to lose sight of that sometimes when we're in the midst of a bull run. The 5-year returns don't look a whole lot better, by the way. It's not just 10 years. Even 5 years at a 22 PE are, pretty putrid returns. So, it's not, again, a great time for long-term success when you buy the market at 22, 23 PE valuations. But if we look at a few others, here's the CAPE ratio, which is the cyclically adjusted price to earnings ratio. It just hit its highest level in history. The only other 2 times it's been this high, one was again in 2000, and then way back here during the Great Depression. So that's pretty high. Here's another one, the Shiller PE. It crossed 40 at the end of the year. So in 154 years of history, this is the 3rd time that it's reached this level, or anything over 30. So very extreme. If you add all of those different metrics up, you can see there's only been a few times that we've been this elevated, 2000, 68, 29. So it's kind of a who's who of difficult times from a valuation perspective to try to be an equity investor, because markets are pretty expensive at these levels. This is one of my favorites. It's Warren Buffett's favorite. It's the stock market cap to GDP ratio. It ended the year at 218%. You can see that's pretty high. All that means is the market is very high relative to economic growth. Buffett said a long time ago, if the ratio approaches 200%, as it did in 1999, you're playing with fire. Well, we're 218. What does that mean in the short term? Probably nothing. But in the long term, I can tell you Buffett has been raising cash, as we know. He just retired, of course, but he's been raising cash. At the end of the 3rd quarter, it was up to 32%, or about 380 billion in cash. And he's been actually raising cash for some time now, for a number of years. He knows that you don't know the catalyst in advance. And I think he's just wanting to wait for a better opportunity to put cash to work like he did in 2007. And before we poo-poo Warren Buffett and say, hey, he's retired, he's 95, he's lost his touch. His final score from since 1965, when he stepped down at the end of the year, Berkshire was up 6 million% versus the S&P at 45,000%. And this stat is remarkable. If Berkshire dropped 99%, he still would have outperformed the S&P since he took over. So, he's got something going for him in terms of his ability to try to be a patient investor. So lastly, let's take a look at sentiment, because season sentiment is can be reflected in the seasons as well. Well, I will tell you, as we start 2026, it's the season to be bullish. Individual investors are expecting a return of 10.7% above inflation. So they're looking for 14% a year returns for the next 10 years. Financial advisors think that we're going to get like 11% returns. According to Bloomberg, all 21 strategists interviewed expect stocks to rise in 2026. So 'tis the season to be bullish. Inflows into equities had a record year, 1.4 trillion last year, 200 billion more than the year before. So investors are putting their money where their mouth is. Foreign investors, how about this one? I thought this was kind of surprising. Foreign investors bought more than 700 billion worth of U.S. stocks over the last 12 months, the largest inflow in history. So it's not just U.S. investors. Bank of America shows their households hold at 66% allocated to stocks is the record high, matched here, and then even a little bit higher than back here, even higher than the '07 top. So investors are very bullish. They're putting their money where their mouth is. I saw this chart from Michael Burry. I thought it was really interesting. It's very rare to have more net worth in stocks than in real estate, because for most people, real estate is their biggest asset. So it makes sense that over time you wouldn't see that. But well, as we end the year last year, household stock is now higher than real estate. And we only saw it a couple other times. One was back here in the late 60s. One was here at the end of the 90s, and we're seeing it again now. So a lot of exposure to the equity markets. Margin debt, you can see spiking. That doesn't mean much necessarily, but it does mean that oftentimes margin is an expression of risk taking. So when you see these big spikes, it tends to happen near market, blow-offs really. But this is interesting to see. So anyway, sentiment is a season of bullishness, a season of extremes, as is overconcentration, and so is valuation. So I think those seasons are all ripe, if you will, sometime in the next 3 to 12 months to see perhaps a new season emerge. And we'll talk about some of those opportunities in a minute. So let's move on to the most notable change of seasons, which is in the real asset space, commodities, other assets similar to commodities. I've noted this in the past, but if you take a look at the commodity space and you look at the last 15 years, this is a great chart because it goes back 15 years and it highlights from 2011 through the end of last year, all these different assets and their performance. And if you come to the right, you can see the cumulative return and the annualized return. And it's been great for a lot of asset classes, particularly US stocks. But I want to highlight one asset class over the last 15 years has been negative annually, and the cumulative return was negative as well. And that's the commodity space. And I suspect when you look at, as I showed you earlier, and you look at last year, 2025 returns and how we saw a season change underway with the commodity space coming to life, in particular precious metals, we're going to see more of that as we move forward. So you take a look at this is the broad commodity index, the CRB. We had this huge bear market that was about 15 years. It ended in COVID. We had a blast out of that. And since then, we've been moving sideways. So we have this big base building. And as you can see, I highlight where I think the future may be taking us, depending on how the inflation picture shapes up. The base that's been building in commodities is very long. We're 1, 2, 3, 4 plus years of this sideways base. And as I'm going to show you later on gold and silver, sometimes those bases, when they break, can be very, very powerful. I highlight on the next chart, we know that gold had a big rise. Gold moved sideways for 13 years, and gold's broken out of that base. Well, commodities tends to follow. The black line is equal weight commodity index, tends to follow the precious metals really. And you can see it has not been yet. It's moving sideways. So hypothetically, you can say, at one point, when is this going to kind of kick into gear and follow higher? These ratio charts are fantastic. This is the commodity index versus the stock market. I've shown you this chart before, but if you look at this, when it's rising, you have commodities outperforming stocks. When it's falling, stocks are outperforming commodities. So you go through these periods of ebbs and flows where commodities outperform, stocks outperform, commodities outperform, stocks outperform, commodities, stocks, commodities. We've had this long 15-year period where stocks have outperformed commodities. And again, hypothetically, you have to say at some point that's going to turn. That doesn't mean stocks don't perform at all. It just means that commodities have a better window of time for the next 5 years of outperformance. We've also got this period of time. If you look at gold, last year we had gold outperformance. Really, the last 2 years, gold has had a spectacular run, 26 and then 64%. We're all well aware of that. We've had a very healthy allocation for clients. I highlighted that that was expected because you had a gold bull market from 2000 up until about 2011, about a 700% gain. Then we had a 13-year base. And remember, the longer the base, the higher in space. And so now gold has kicked off another run, likely to be very similar to this one over the next 5 to 10 years, potentially. Just understand, over this 700% gain, it wasn't always straight up. There were a lot of corrections, 11, 18, 14, 10, 26% pullback. So 34% pullback. I'm sure people were calling the end of the bull then, but we had a continuation. So it was, this 700% rise had plenty of pullbacks along the way, as is normal. This is another ratio chart. And again, it highlights to me why I think we're seeing a change of seasons here. Because this is, again, gold versus the S&P. When it's rising, gold's outperforming. When it's falling, stocks are outperforming gold. This has been falling now, as I said, for 13 plus years, and it's just now turning up. And again, I suspect this is probably going to at least make another run higher towards the previous highs. This is a similar look, but shorter duration. This is gold versus the S&P 500. Multiple times it hit resistance, once, twice, 3 times, 4 times, and it's just now starting to break through. So you can make the case, because again, this is a very long-term monthly chart. So each of these bars is months. You can make the case that it's just now starting to break out versus the stock market, which is very encouraging. Same thing with GDX versus the S&P, which is just gold miners. Gold miners are looking very similar. Once, twice, 3, 4 times now, just now starting to break out versus the stock market, which just highlights the potential that it's just now showing that it wants to outperform as an asset class. How about silver? You talk about a base. Silver has a base that goes all the way back to 1980, where it hit 50, had a huge cup, hit 50, had a huge handle, and just now started to break out above that. That's why, there's a lot of optimism there that this is a real breakout that may just be starting. And you see you look at the same chart where silver versus the stock market. Again, silver outperformed here. Stocks have outperformed all this time, but we're just now seeing this breakout. It broke out above this and it started to move higher, showing a potential period of outperformance for silver versus the equity market. So again, potentially a new season. Definitely been a new season for central banks buying gold. They have been buying gold extremely aggressively the last 3 or 4 years. You can see how it's been ramping higher, which has been a catalyst for the gold market. And they bought so much that they're now they hold more gold than they do treasuries. So again, a new season is upon us where gold is now being viewed, at least by central banks, as a safer reserve asset than the U.S. Treasury. And there's another catalyst has been the rise of our debt. The U.S. national debt, which I showed you earlier, was at almost 39 trillion. You can see gold price has finally been catching up to the rise in treasuries outstanding. So, we've seen these periods where it got a little ahead of itself, had a sideways move. Treasuries have been going parabolic, and gold is starting to catch up to that price. So keep that in mind as terms of the future and the new season upon us, not just in the commodity space, but also potentially in the precious metals as being early, if you will, in a new season where they're potentially starting to outperform the equity markets. And I just threw this in at the end because I talked about energy, and I said early on, and I said maybe 2026 could see energy catch a tailwind because it was the laggard in the commodity space last year. This chart was good. It shows gold breaking out, copper miners breaking out, gold miners breaking out, energy stocks kind of moving sideways. Looks very similar to this before it did finally start to break out. So again, question mark there, but potentially a new season in the energy space. And one of the catalysts has been a weaker dollar. I'll end with the currency look. Um, are we in a new season of change when it comes to the dollar? Well, we know the dollar index fell 9% in 2025. It was its worst performance in almost 10 years. If you take 2017 out of the equation, it was the weakest year going all the way back to early this century. So definitely dollar weakness seems to be new in a new season. We've had this rising channel, and I've shown you that, and we are clinging to life on this channel. So it'll be very interesting to watch the first half of 2026 to see, does the dollar rally as it did here and kind of make its way back towards the top, or does it break down? Because this channel has been in place now going all the way back to the early 2000s, and it could be a new season upon us if this breaks. Could really usher in some more weakness. Part of that's being driven by the euro. Remember, the dollar is just a basket currency. So the euro strength, the euro is 60% of the dollar basket. So the euro, as you can see, really struggled for years to get above this line, and it's just starting to show real strength. So if we see a period where the euro breaks out and has a meaningful rise, almost certainly that means the dollar is breaking down. You can see that when you overlay the dollar. And again, in this one, the euro is in black and the dollar is in blue. So the euro has been showing some strength, the dollar has been showing some weakness. You have this gap here, but there have been times when that gap gets very wide. It always closes, and they move almost mirror image of each other. So as goes the euro strength, so will go the dollar weakness. And in terms of new seasons, remember, we have had the great fortune of being the world's reserve currency now for about 100 years. And you can see that as seasons go, that's about as long as it lasts. You can see each of these countries had their time in the sun as the reserve currency, and the dollar now going all the way out to 2026 is pretty long in terms of when it began, and that may be a new season upon us as we move forward in the next, say decade, to see how that evolves as well. But dollar weakness will certainly be good for commodities, precious metals, and some of those real assets. So wrapping it all up, 2026 themes, a new year of seasons, potential new opportunities as well. Taking a look and keeping exposure to real assets, I've covered that. Perhaps value over growth becomes a new season, a new expression of market performance. Defensives rebound. I showed you that chart that showed how technology and defensive sectors are now, at new highs and new lows. So whenever that turns around, that's going to definitely be a new season ushered upon us. Same thing with equal weight over market cap, in terms of a broader market performance versus just a very narrow market performance, and even international outperformance. 2025 does not a new trend make, but we definitely saw outperformance there, and maybe a weaker dollar can help be a driver to that end. So here we are with our normal compliance page, and I'll wrap it up. Say thank you so much for being here. As always, we appreciate your friendship. We appreciate your trust and your confidence. You can follow along at the morning roundup. You can call, and I'll be happy to add you if you're not on that, where I cover a lot of these and a lot of these charts come from. If you have any questions, please reach out to either David or myself and be happy to address them. Thank you very much.